All right, let's dive in. Today, we're going to tackle a topic that pretty much every working person in India has to deal with: income tax. I know, it can feel super complicated, but trust me, by the end of this, you'll get the big picture, you'll understand your payslip, and you'll know what's what. We're going to demystify this thing together.
You know that feeling, right? You get your payslip, you're excited, and then you see that line item for tax, and you see this chunk of your hard-earned money just gone. Where in the world does it go? We have all been there, but honestly, figuring out the why and the where is the very first step to really getting a handle on your own finances.
Okay, so first things first, let's get a quick clarification out of the way. In India, you've got two main kinds of taxes. There's indirect tax, like GST. That's the tax that's already baked into the price of stuff you buy. But today, we're focused on direct tax. This is the one you pay straight from your pocket to the government based on what you earn. And the biggest, most famous example? You guessed it, income tax.
So before we get into all the numbers and the how-to, let's just touch on the why. Why do we even pay taxes in the first place? It sounds basic, I know, but when you get this part, the rest of it makes a whole lot more sense.
The easiest way to think about it is this. Taxes are basically the subscription fee we all pay to live in a modern, functioning society. It's the government's main source of income, the money they use to build and run all the things that benefit all of us. Without that money, a lot of the public services we just take for granted, well, they just wouldn't be there.
So what does that subscription fee actually get us? Well, a ton, actually. We're talking about everything from our national defense and the salaries for our soldiers, to building new roads and dams, to funding public schools and hospitals. Your tax money is literally the engine that keeps the country running and growing. Okay, time for the nuts and bolts. How do you even figure out what income the government is going to tax? Well, the Income Tax Department sees your earnings as a 5-piece puzzle. Let's look at each piece one by one. Before we can even begin to talk about tax rates or anything like that, we need a starting point. And that starting number is your gross total income, or GTI. Just think of it as the grand total, the sum of every single rupee you've earned from all possible places before we start subtracting anything. First up, the most common piece of the puzzle for most people: income from salary. This isn't just your take-home pay. It's the whole shebang: your basic salary, any bonuses, allowances, even your pension. For most of us, this is the biggest chunk. Piece number 2 is income from house property. Pretty straightforward. If you own a property and you rent it out to someone, that rental income you earn gets added to your total right here. This is a big one for any landlords out there. Third, we've got profits from business or profession. This category is for all the entrepreneurs, the freelancers, the consultants. It's not your total revenue. It's the profit you're left with after you subtract all your legitimate business expenses. Number 4 is capital gains. This one pops up when you sell a big asset, something like a piece of land, a building, or even stocks and mutual funds. The profit you make from that sale, the selling price minus the price you bought it for, that profit counts as income. And the 5th and final piece of our puzzle is income from other sources. This is basically the catch-all drawer for everything else. We're talking about interest you earn from your savings account, dividends you get from shares. Hey, even if you win the lottery, it goes in here. So let's put it all together. You look at those 5 categories, you add up whatever you earn from each one that applies to you, and bam, the number you get is your gross total income. That's step 1, a major milestone in figuring out your tax. But wait, once you have your GTI, we're not done. Now comes the strategic part, the part where you can legally lower that income number to pay less tax. Welcome to the great deduction game. So what exactly are deductions? Well, think of them like government-approved discounts. There's specific expenses or investments like your contribution to a provident fund or your health insurance premium that the government says, okay, you can subtract this amount from your income. And this is crucial. The final number you get after these deductions is your net taxable income. That's the amount you actually pay tax on. And that brings us to what is probably the single most important choice you have to make as a taxpayer in India every single year. You have to choose which tax system or regime you want to use. And this choice can make a huge, huge difference to how much tax you pay. Here's the fundamental trade-off, laid out plain and simple. On one hand, you have the default regime. It's simple, it's automatic, and it offers you lower tax rates. Sounds great, right? But the catch is you have to give up almost all of those deductions we just talked about. On the other hand, you have the optional regime. The tax rates here are higher, but you get to claim all those deductions. This can be a game changer if you have, say, a big home loan or lots of investments. Let's look at how different these rates really are. Look at the optional regime on the right. See that? The moment your income crosses 5 lakhs, boom, you're in the 20% tax bracket. But in the default regime on the left, you're paying much lower rates, just 5% and then 10%, all the way up to 10 lakhs. This is the heart of the trade-off rate here. Let's make this real with a quick example. Let's say your income is 12 lakhs and you have 2 lakhs in deductions. If you stick with the default regime, your tax is calculated on the full 12 lakhs and you'd pay about 80,000. Simple. But what if you chose the optional regime? You could use your 2 lakh deduction, so you'd only be taxed on 10 lakhs. Sounds better, right? Well, because the tax rates are higher, your final tax bill would actually be over 1 lakh. This shows you perfectly why you have to run the numbers and compare every single year.
We are so close to the finish line. Once you figured out your base tax amount using one of those 2 regimes, there are just a couple of final things that get added on top to get to your final tax bill. The first one is called a surcharge. The main thing to know about this is that it's basically a tax on the rich. It's an extra charge that only kicks in if your total income is really high. We're talking over 50 lakh rupees. So for most people just starting out, this won't even apply. Now this second one, this applies to everyone. It's the health and education cess. And listen up, because this is a really important point. It's a 4% charge, but it's calculated on your tax amount, not on your income. It's literally a tax on your tax. And that money is specifically set aside to fund health and education projects across the country.
Whew, okay, we have covered a ton of ground. So let's just boil it all down. What are the absolute key things you need to walk away with?
Here it is. Your simple 4-point tax checklist. 1. Add up your money from those 5 income types to find your gross total income. 2. Make a list of every single deduction you could possibly claim. 3, and this is the big one, run the numbers for both the default and the optional regimes to see which one saves you more money. And 4, hey, this stuff can get tricky. If you're ever not sure, it is always a smart move to talk to a tax professional. So there you have it. You now have the fundamental building blocks, the basic rules of the game. Understanding the Indian income tax system isn't just about paying up. It's about knowing the rules so you can make smart choices for your own money. The first step is knowledge. The next step is making that knowledge work for you.